This is TreppWire Week in Review for the week ending August 16th, 2024. I'm Curly Sento with Trepp, a data, modeling, and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm guest hosting today while Haley is out on vacation. If you didn't know, the TreppWire team has not missed a weekly podcast since they've started, and I'm so excited to be here with Lonnie Hendry, Chief Product Officer, and Stephen Bushbaum, Research Director. As we all know, last week was a volatile one. We saw bears coming out of hibernation at the first whiff of bad news, as well as the impact of different rate policy directions in different major economies. But now we're settling back into a more typical cycle. We'll be keeping a close eye on domestic inflation, labor, and retail spending data, as these numbers will give us a clearer picture of where our economy is heading and just how bumpy the landing might be. Some recent highlights include the NFIB Small Business Optimism Index exceeded expectations, both producer and consumer price indices beat forecasts, and the year-over-year inflation is now back in the 2% range. Talking heads set the stage for the Fed to start cutting rates in recent weeks if we got the cooler inflation prints and good enough retail sales numbers showing that the U.S. consumer is still spending. We got the former, and we have some indications about the latter. So, set against the lower job creation and weaker wage growth that we've seen recently, how are you making sense of all this new data, Stephen?
Well, this has been a very interesting dynamic to follow these past 2 weeks. I mean, things got really, really bearish. 2 weeks ago, Friday, going into Monday, we talked about that sell-off and decomposed the various components, but we absolutely ripped back from those levels and came back to almost even on the week. So to me, it feels like the market collectively took a deep breath in, deep breath out, and said namaste, and we've kind of moved on to calmer heads. Because if there were lingering concerns about an imminent recession, I would expect equity pricing to still be down from where we're at. But we've kind of normalized, albeit with some underlying anxiety. I mean, it's palpable. You can feel it in the market. People are anxious about the direction of the economy. But what's been especially interesting to watch is what's been happening in bond markets, specifically treasury markets. If we look at the forward probabilities for a Fed rate cut, specifically for September, 1 week ago, we were at a 69% chance of a 50 basis point cut. And last week I said, well, given the data points that we've had so far, namely the weaker labor print, unemployment rate going up, and the collective data as of that point in time, 50 basis points made sense. But since then, we've gotten some calmer data that indicates, well, maybe this isn't as predestined of a slippery slope for employment as what we all thought with the non-farm payrolls and the unemployment rate a couple weeks ago. Getting back to the forward probabilities, it was a 69% chance of a 50 basis point cut 1 week ago, and that's been almost half. So today, we're sitting at right about 36.5% chance of a 50 basis point cut and a 63.5% chance of only a 25 basis point cut. Here's where it gets interesting, though. If you look forward to December, the collective number of cuts that the market is pricing in is somewhere between 75 and 100 basis points. And 100 basis points actually has the highest probability as of today. To put this in explicit terms, the likelihood of the Fed's target rate being cut to a 425 to 450 range is just over 44% today. And either side of that is about 25% chance. So the market is pricing in a pretty significant number of cuts through year end. But as of right now, I look at this and think, if the Fed's only going to cut 25 basis points in September, I feel like that's only going to kind of continue at a steady pace. I don't feel like the Fed is going to start off with 25 and then ramp up. Lonnie, what do you think here?
Yeah, I'm aligned with your rationale there. I was listening to Bloomberg this morning, and it's really interesting. Everyone's been clamoring for these really large interest rate cuts and aggressive action from the Fed. We get the numbers today, and everyone's saying if the Fed cuts 50 or 75 basis points in September, they're pushing the economy into a recession because everyone's going to take those actions by the Fed as saying the underlying economy is weaker than anticipated, and they're having to take emergency action on the cuts. I'm also starting to believe that these forecasts on what the Fed's going to do are less reliable than a typical weatherman's forecast every day, because every month we're talking about 90%, 60%, 70% probability of this or that happening. And without fail, like usually they're incorrect. So I liked your description, a deep breath in, a deep breath, or deep breath out, deep breath in, however you wanted to, you frame that. That's kind of where we're at. I mean, I think cooler heads have prevailed. The market has taken the hit and come back. and I think it's setting up for a 25 basis point cut. The data today was good. I don't think anything there just jumps off the page as saying the Fed has to take immediate aggressive action. And I think, quite honestly, given where we're at with the election cycle and everything else that we've talked about ad nauseum, a 25 rate point reduction would be exactly what's needed right now. Anything more than that, I think, gives the talking heads too much ammunition to kind of pontificate on the narrative. And what I said a couple of weeks ago, and I still believe, is when the market's where it is right now, consumer sentiment and a shift in just belief that the economy is strong, I think, has a contagion effect on the negative side, unlike what we've experienced lately. And so we withstood the rate increases. Now it's stabilized. If they come at 25 basis point, it signals that the market is where it needs to be and the Fed's taking some action, but it doesn't set off the alarm bell. So I would suspect that we see calls for that 25% becoming stronger and stronger as we lead up to the next action from the Fed.
Yeah, and a shout out to Scott Hine over at Texas Tech University. He's been really active on LinkedIn talking about the big issue right now, which is, okay, that's great that inflation has come down to 2.9%. We'll dig into some of the economic data from this week. But the big problem is that prices are still up 20% over the last 2-3 years. To undo that damage is very, very difficult. And if you're too quick to cut rates, that in itself can be inflationary. So we've gotten ourselves in a bit of a pickle, and you're definitely starting to see some of that weakness percolate up through some earnings commentary and some revenue misses that we've heard about recently. And I just got to say this one more time, not to belabor the point about what's transpired the last 2 weeks following that non-farm payrolls number, but I can't help but point out the irony here in that the market was, in some respects, there's a lot of chatter criticizing the Fed for being too data point dependent. They say they're data dependent, but sometimes it feels like they're too data point dependent. Lo and behold, 2 weeks after this sell-off, it feels like the market itself was maybe a little bit too much data point dependent.
Spoken like a true data nerd. Thank you, Stephen. It is interesting how data drives the market, but the narrative around individual data elements can sometimes really have an outsized impact, both positive and negative. So I think the point's well taken. It's interesting. We talked about soft landing, I think, for the last 12 months or so. It feels like we're in an airplane that just keeps circling the airport at this point. It's like they go in and they're going to try the landing. They don't like it, so they go ahead and just take it back off and then they circle around again. At some point, that plane's going to run out of fuel and they're going to have to make a landing. And I think we're getting closer to that. It's interesting, though, if you talk about 20 or 30% price increases, depends on what you're talking about. A lot of things are up way more than that, and I think the inflation print and stuff that we look at, the CPI, it just gets lost in the reality of what people are actually feeling, especially in those, median and lower economic stratas. The cost for their goods and services are very high, and the data today doesn't really change the narrative for them when it comes to getting paid this week and having to buy groceries and put gas in their car.
I got to say, speaking of, the type of inflation you're talking about, Lonnie, when I moved from Texas to New York, I sold all of my tools. I mean, everything. And that pains me. I love do-it-yourself stuff. I had some fantastic tools. I started looking back at prices I had paid for these things 2 to 5 years ago. I mean, shoot, some of these were like 3-year-old tools, and the price is up like 50% on those things. Yeah. It's nuts.
It's crazy how that is. A lot of goods are that way right now. So we have a lot of other economic data to kind of go through today. S&P 500 consumer discretionary is down 1.7% on the year. The only sector in red. If you look at McDonald's, they said customers are picking cheaper items and going to its restaurants less often, which is driving down U.S. same-store sales for the first time since 2020. Starbucks reported another quarterly decline in sales. Chipotle said its sales growth is cooling. And there was a quote here from the McDonald's CEO on their earnings call that low-income consumers in many cases are dropping out of the market, eating at home and finding other ways to economize, cutting down on trips. Home Depot did rise 1.2% on revenue and EPS beat. And despite the company cutting its outlook for comparable store sales, saying higher interest rates weighed on home improvement spending, and high interest rates continue to weigh on new and existing homeowners. Louis Vuitton and Dior said sales rose, a disappointing 1% from a year earlier. Gucci's owner said the sales fell 11% and issued a profit warning. And then if you look at a couple of other banks that have had to work harder to make capital work for them, effectively paying nothing on savings accounts for many years. They're being forced, and you've talked about this at length, Stephen, to offer higher yields to prevent customers from taking their deposits elsewhere, putting downward pressure on margins. Higher rates are also negative for them in the sense that fewer people take out new mortgages or refinance their existing mortgages. And consumers are spending big on credit cards and carrying balances. And we've talked a little bit over the last month or so around the delinquency percentages on credit cards and so forth. So there's a mixed bag of economic and retailer news. We'll have more to come on this. And then I know you were going to walk us through some of the net negative stories related to hotels and bad debt out in the San Francisco marketplace.
Yes. And before we dive into that, I just want to outline for our listeners some of the topics we have in store for today. Because if you haven't been able to tell already, the data we've been getting is very much, or at least will get you worried about certain sectors in particular. So office, retail, and lodging. And that's what we have for you today. So next up, as Lonnie said, we had helped our friend Neil Mehta at the Wall Street Journal with a story he was working on regarding bad hotel debt in San Francisco. So Neil cited us saying, quote, in the city's metropolitan area, the delinquency rate among commercial mortgage-backed security loans for the lodging sector skyrocketed to 41.6% in June from 5.7% in June of 2023. This is the largest increase across the country's 25 largest metros. Lonnie, you and I have talked about the issue that you have sometimes with very large loans skewing numbers a little bit. And yes, you do have some very large deals that have gone sour in San Francisco. But given the collective data and the stories that Neil pieced together from boots on the ground, it's a real struggle out there. And we've been talking about this for quite a while. So back in our May 24th edition of The Rundown, in the big picture, we talked about more trouble for San Francisco hotels. And our friend Arrest at CRE Direct has done a fantastic job outlining a number of different properties in this big picture story, both from CMBS and in non-securitized space. So these are properties that have debt that are not in CMBS. So the two biggest hotels, or the biggest really hotel story that hit last year, had to do with the Park Hotels and Resorts, noting that they were going to turn over its roughly 1,000 room Hilton Park 55 and its 1,900 room Hilton San Francisco Union Square properties, turn those properties back over to the lender. And the CMBS trust that holds those loans has a $725 million mortgage against them. Moving away from those two particular properties, because we have talked about Hilton Park 55 and the Hilton San Francisco Union Square a number of times, the San Francisco Business Times had also reported recently around that same point in time that Westbrook Partners had defaulted on a $72.5 million loan against the 155-room Four Seasons Hotel San Francisco. The property's lender, Waterfall Asset Management, had hired JLL to sell that loan. And this is a loan that they had purchased some time ago from HSBC. Moving on, we have Ramsfield Hospitality Finance and AB Carval had earlier taken title to the 248-room Kimpton Alton Hotel in the city's Fisherman's Wharf area. The team had provided $85 million of financing against the property 2 years ago. Moving on to yet another property, the Hilton San Francisco Financial District, another one that we've talked about on the podcast, has 543 rooms at 750 Kearny Street. It had struggled with its $106 million of indebtedness, which includes a $20 million mezzanine loan. The debt had matured in January, but the property's owner, an affiliate of Intergroup of Los Angeles, had been trying to negotiate an extension of its term. The property had operated a relatively healthy 83% occupancy level during the 12 months through last June, but cash flow was roughly half the amount the property had generated in 2019. And Intergroup had noted that San Francisco had been one of the country's slowest cities to recover from COVID lockdowns. Now, fast forward to July 1st, in another edition of The Rundown, we talked about the Hilton Park 55 and Hilton San Francisco Union Square again. Wells Fargo Bank, the special servicer, had hired Eastdale Securities to sell these two properties. And as some background, the two properties haven't been able to muster positive cash flow since 2020, when it was negative $22.96 million. During the 12 months through last March, the two properties had operated at 52% occupancy and had generated a $15.6 million cash flow deficit. That's right, a cash flow deficit. So there's been a lot of struggles in the San Francisco MSA. Part of this is stemming from the absolute decimation of the office sector and the tech rec that has seemingly sort of stabilized. You have a reduction in leisure travel to the MSA and also conference activity conference bookings are down dramatically because Las Vegas has made a very strategic, very tactical move to try and pull some business away from San Francisco. The Chamber of Commerce and the powers that be saw an opening and they capitalized, and that has come to the detriment of San Francisco. So there's a lot of work ahead for this MSA to try and claw back to where it had been.
Oh, there's a lot to digest there, Stephen. I want to add some perspective and maybe get your comment on a few things. San Francisco, we've talked about not just for hotels and office, but it seems like the retail sector there, unlike the rest of the U.S., has really been facing some significant challenges coming out of COVID. This life safety, quality of life challenges that we're seeing across the city have effectively now taken down 3 or 4 of the major food groups in the CRE landscape. So it was really interesting. And part of the calculus that Park Hotels used to determine whether to give up the hotels, they determined the hotel performance is tied very closely to office vacancy rates. They had found an 88% correlation between the two. So if you go back and look, in the fourth quarter of 2019, the city's office market had a sub 4% vacancy rate, the lowest in 18 years. RevPAR, which is used to measure revenue per available room in the hotel space, had increased by nearly 18% to record levels. The office vacancy rate now has ballooned to 37%, which was up slightly from 36.7% in the first quarter. That comes to us from data by CBRE. The hotel occupancy rate, according to San Francisco Tourism, was at 64% in the first quarter. And it's really interesting. Take away the retail, which takes away the foot traffic. You take away the office occupancy, which takes away the business traveler. And guess what? There's not a whole lot of other people coming in to stay at these hotels. This is going to get worse before it gets better. If you want to get some insight on this, 41.82% delinquency is what you read as the headline number, Stephen. 83.13% of the hotels in our data set in San Francisco have debt service coverage less than 1. So while the delinquency number is an astronomically high number relative to what it was 12 months ago or any of the other MSAs in the US, it's only about half of the current hotel inventory that's not even generating enough NOI to cover debt service or cash flow to cover debt service. So it'll be really interesting to keep an eye on this. Obviously, for our listeners, if you're a customer or client or you're a subscriber to our Rundown newsletter, we're going to be tracking these stories real time and putting them out across our different publications and forums. If you're from the San Francisco market and you have insight on any of these deals or transactions, or if you've heard of whisper prices or anything on any of these hotels that are currently being offered, shoot us an email at podcast@trepp.com. We'd love to give you a shout out on the air and talk through your insights.
All right, so transitioning from a struggling San Francisco, let's head over to Texas, to Y'all Street. Lonnie, as our resident Texan, what do you think about this Wall Street Journal story?
I definitely use the word y'all. I sometimes wear a cowboy hat and I drive a pickup truck. I don't ride a horse to the office though, so we're not quite that y'all down here in Texas. But this story is interesting. It talks about Texas becoming a burgeoning financial hub. This was in the Wall Street Journal this week. For those of us that are in the Texas region, we know Ross Perot has a really large real estate investment company called Hillwood that has done large-scale projects, commercial, residential, master plan communities, et cetera, for years. They're actually partnering to build $500 million Goldman Sachs Tower, which is going to house more than 5,000 bankers and investors. Makes it the financial firm's second largest office behind its New York office. In the story, it says, as a helicopter swung northwest, windows glinted from 2 unfinished Wells Fargo office towers scheduled to open next year. A bit farther away, a 4th office building under construction for Charles Schwab, which moved its headquarters from California to Dallas area 5 years ago, and the footprint of a Deloitte campus doubling in size. So the reality is there's a lot of financial services firms, there's a lot of activity in and around the Dallas area, which is just contrary to what we've seen nationally. These are large office projects, which obviously then helps the multifamily and it helps the retail development. So if you drive through Dallas or Uptown or any of the suburbs in Frisco, Plano, et cetera, you're seeing significant activity in the marketplace. If you look at data from the Bureau of Labor Statistics, it shows that Texas investment banking and securities employment has increased 111% over the past 20 years and 27% since the pandemic, compared with 16% and 5% respectively in New York. The number of people overall employed in finance has risen 13% in Texas since 2019, compared to 2% in New York and 3% nationally. Dallas now ranks second to New York City among metro areas in the number of workers employed in finance-related industries. And then there's other cities, particularly in the Sun Belt, have seen growth as these services increasingly seek to be closer to customers nationwide. So before our New York listeners start, sending us hate mail about Texas is not New York, I'm the first to say and admit Texas is not New York. Dallas is not New York. I will, however, counter and say we've seen a pretty large exodus, measurable exodus, quantifiable impacts, positive in nature for the Texas economy, with large-scale companies moving out of high-tech states like California and New York and relocating to Texas. And it's higher educated, higher earner financial services type of roles that we're seeing here. And it's really great if you look at quality of life index on the whole, Dallas in particular, Austin, et cetera, rank really, really high. It's an affordable place to live. There's a lot of professional sports teams, recreation, and other things to do in the cities. And you're effectively a 3-hour plane ride anywhere in the U.S. from the DFW airport in Dallas. There's a lot of appeal here. I think we see continued growth in this region over the next 5 or 10 years. I don't think this is going to slow down. The underlying fundamentals are really strong here. Texas has more than enough available land. And unlike a lot of the other major metros across the U.S., it's very pro-growth here. So if companies want to come and build, there's not a lot of red tape. You can get construction projects approved and you can get them shovels in ground very quickly. So it'll be interesting to see. We have some Dallas MSA office market statistics here. If you look at debt service coverage ratio and net cash flow across the Dallas MSA in the office market, it's sitting right now at 1.57x. That was as of end of July 24. Average LTV across that sector sitting around 72%. Average debt yield is strong at 11.14%. And if you do some comparison between Dallas and New York, the numbers, they add some validity to the Wall Street Journal story. I mean, occupancy across the DFW metro and the office market is around 91% right now. Now, this is not utilization. This is occupancy. So this will be physical occupancy per rent roll, not necessarily how many people are showing up. But you do the same analysis in New York. Right now, New York MSA, which is in New York, Jersey City, sitting about 94%. Debt service coverage is relatively the same, and delinquency rate for both is sitting just above 5% for the two office markets. So it's a pretty nice running debate. We could definitely go back and forth on this one, Stephen. I love New York. The energy there is infectious. It's unlike anything else. But I will say the Dallas market has really taken its foothold as kind of the second hub, I guess, for this financial services sector, with some of the cities in Florida, really making a push to kind of round out the top 5.
Well, and there's one other factor that we'd be remiss if we didn't mention in this segment, and that's that Texas is on the verge of establishing its first national stock exchange. And this is an effort led by James Lee, an experienced entrepreneur and financier. And the Texas Stock Exchange, or TXSE, has successfully raised about $120 million from individual investors and large firms. So, I mean, this would be a massive deal if this thing does hit on target. The aim is to start trading by late 2025 and list its first companies by early 2026. So, I mean, this is a huge move. So back to your point, Lonnie, I mean, Texas has been gaining momentum for a long time. And right now they're tied. I can't remember if you just said this, but they're tied with New York for the second highest number of Fortune 500 companies, with 52 headquartered there. And this is only second to California. So this is a really big deal. And I feel like if you do have that stock exchange get launched, that's the icing on the cake. That's sealing the deal, cementing Texas's place as a new financial capital in the US, which is, as you said, really a good thing. And for anybody that's interested in some supplemental reading, I got to give our friend Matt Levine over at Bloomberg News a shout out. He did an absolutely fantastic write-up on the Texas Stock Exchange launch and explains it in the simplest terms possible. In fact, he starts it out talking about, well, what is a stock exchange? What is an exchange, period? It's a bunch of people meeting under a tree and trading some paper, or at least that's how it starts out. It's a fantastic piece.
Well, and when you're explaining things to those of us down here in Texas, you have to go slow and you have to make sure that we can follow along, because we're definitely not as sophisticated as our New York brethren. But the population trends here in Texas it's unbelievable. You see the number of people moving here. We're starting to see a little bit of softening in the housing markets across several of the cities, but outside of small blip in the housing markets, multifamily has outperformed. It's incredible to see just the transition of the state diversifying itself away from just oil and gas and what it had been as a primary business driver 25 or 30 years ago, now to, Austin has been known for being a tech hub, Dallas now financial services. It's really cool to be part of it. I'd love to throw out for the Wall Street Journal, next time you're in town, flying around in a helicopter, checking out commercial real estate buildings, I'd love to piggyback on that.
So now let's transition over to credit stories of the week and let that last story ride off into the sunset, Lonnie.
So first up, we have a large trading alert that we just put out this week on a large New York mixed-use SASB loan that was transferred to the special servicer. The $335 million Times Square Plaza loan has been transferred to the special servicer for imminent default, according to August remit data. The loan is still current on payments, but is scheduled to mature in October. So this is following a very common pattern we've seen with loans transitioning to the special servicer anywhere between 1 to 6 months ahead of their scheduled maturity date. As I mentioned, this loan makes up the entirety of the collateral behind a 2014 SASB deal. The property also supports a $170 million mezzanine loan. The collateral is a mixed-use property with 506,000 square feet of rentable area in the heart of Times Square in Manhattan. The property was built in 1972 and renovated in 2014. And the asset was last appraised at securitization in 2014 at $810 million. The top tenant with 13% of the space has a lease expiring in May of next year, and the second largest tenant, taking just under 10.5% of the space, has a lease that ends at the end of this month. In the first quarter of 2024, the loan posted a debt service coverage ratio based on net cash flow of 2.09 times with occupancy at 75%. Servicing commentary indicates that the borrower has been exploring refinancing options since January, with a couple of lenders performing preliminary underwriting. I think this kind of speaks to one of the most common stories that we've seen with borrowers just being unable to obtain takeout financing for the existing debt load. And it takes a lot longer of a lead time to refinance these office properties than would have typically been the case pre-COVID.
Yeah, I mean, could you remember a time pre-COVID, Stephen, where you had a mixed-use property in the heart of Times Square that was having a hard time getting refinanced?
Nope. If anything, you'd have lenders clamoring over each other, offering better and better terms and debt packages.
Yeah, I mean, it's really remarkable. Like, I think, that is the one thing about New York is kind of being the pulse for the marketplace, especially in these really nicely located Times Square type of buildings where the mixed use component, you're going to have foot traffic, et cetera, et cetera. But the dynamic shift in office appeal has just really decimated this. We do have maybe a little mixed green here in the next story. If you put the two together, Vornado Realty Trust is going to actually be able to get another loan to retire the existing $490 million loan at 731 Lexington Avenue. It's a 1.3 million square foot office building in Midtown Manhattan. And this comes from our very own CRE Direct. The New York REIT, which owns the property through Alexander's Inc., of which it owns 32.4%, had considered paying off the loan then with a balance of $500 million with cash on hand. At the time, Stephen Roth, Vornado CEO, suggested not wanting to pay 7 or 8% for the mortgage capital. But the company got the builder's anchor tenant, Bloomberg, to sign an early renewal of its lease for the 946,000 square feet that it occupies. They then negotiated a 4-month extension of the mortgage, which was securitized in a 2017 deal and pays a rate pegged to the prime rate, which is capped at 6%. Had to pay down the loan by $10 million to its current balance. The timing of the lease extension and the flexibility it gave Vornado with the loan extension has worked out in the company's favor. The building, which was constructed in 2004, includes 250,000 square feet of retail space, 105 residential condominium units that are separately owned, and some storage space. Property was last appraised in 2017 at a value of $1.45 billion. So this is a really low loan to value type of situation with a really great credit anchor office tenant that just renewed their lease. But I would say this is a win for the folks at Vornado, not having to pony up cash on hand to pay this off and effectively being able to enter into a new loan.
Yeah, I used to walk by this building almost every single day, and every time I walked by it, I would think to myself, if this thing can't refinance, we're in really bad shape, because this is an absolutely fantastic building. I got to say, if you're ever in the Midtown area during Christmas time, this is always a fun one to walk. It's a circular building with an outdoor atrium, and they put a cluster of Christmas trees all lit up in there. It's actually a beautiful building. So this is, like you said, Lonnie, this is a very good one to hear.
Unfortunately, as we transition over to some retail property, Stephen, it's same old stuff, different day, I guess is what you might say down here in Texas. This is for a Rhode Island mall, which sees a pretty significant decline in its appraisal value. Servicer data this month shows that the mall backing $254 million loan at Providence Place Mall experienced a 20% decrease in appraised value. The appraisal change follows the transfer of the loan to the special servicer back in April, which was for imminent maturity default. The delinquency status on the loan as of August list is performing matured balloon, which if you don't know what that means, Stephen talked about that at length, I think about 3 podcasts ago, and gave a really nice overview. We've also highlighted that on several of our Market Pulse webinars over the last several months. The collateral on this asset contains 980,000 square feet of retail space. Property was built in 1999 and renovated in 2009. The value of the collateral was reduced to $240 million back in 21, which was significant because the property had been appraised at $558 million back in 2011. According to this latest appraisal reduction, the appraised value has now been reduced to $191 million. So we went from $558 million in 2011 to $240 million in 21, down to $191 million now, with a mortgage in place at 255 roughly million. It was transferred to special servicing back in May of 21, again due to imminent maturity default, as the refinance could not have been secured at that time as well. It was modified and returned to the special servicer in February 22 and cash managed for the life of the loan. They did get an extension agreement. The loan maturity was May of 2024. The borrower has no more remaining extension options left, and was transferred, as we mentioned, in April due to the borrower's written confirmation that they would be unable to retire the loan per the commentary. They requested a 3-year extension in the letter, but as evidenced here, have not been able to secure that from the lender. Just for some perspective on performance, in 2023, DSCR at net cash flow was 1.86 times, with occupancy sitting at 94%. And if you look at inline square footage, was currently, this was as of May, 87.6% occupied. So this is another one of those mall stories, Stephen, where, you look at the financials, 94% occupancy, pretty healthy debt service coverage, unable to get refinanced, unable to get another extension from the lender, and appraised values that keep going the wrong direction.
You look at just the movement on tenants in the mix here, and this is such a common story for us. It's not your best mall, not your worst, but given the roll-up we've seen in retail, underperforming stores are getting closed left and right. And to see that Macy's store go under at the location is, I think, a pretty decent bellwether for some of the struggles that face those larger format tenants. And if you look at the sales per square foot for the inline tenants that are the large format tenants greater than 10,000 square feet, back in 2010, their sales per square foot were $134 a foot. The inline tenants with less than 10,000 square feet had sales of about $506 per square foot. And then finally, the food court clocked in at just over $1,000 per square foot. So we don't have updated breakouts on the retail tenants' sales, but from the commentary we've read across the market, you have to think that those larger format stores are just struggling to find a reason to stay open these days. So moving over to our other retail story that we had, a 2015 neighborhood center sees its appraised value cut pretty significantly. So the property behind the $12.7 million Summerfield Shopping Center loan received a large slash in its appraised value, according to July remit data. At securitization in 2015, the property was appraised at $19 million, but most recently, the property was reappraised at $12.7 million. The collateral behind this loan is a 77,000 square foot shopping center in South Brunswick, New Jersey. Stop & Shop was the dominant tenant with 80.6% of the space on a lease that ended in September 2022. The loan had transferred to the special servicer in July of 2022 due to imminent monetary default as a result of Stop & Shop failing to renew its lease. The loan went into payment default in May 2023, and a receiver was appointed in April, and the lender intends to proceed with foreclosure according to servicing commentary. In 2022, the loan posted a DSCR based on net cash flow of 1.68 times. And in the first 6 months of 2023, the DSCR fell to negative 0.24 times. So it's now in negative cash flow territory. The occupancy was 19% as of June 2023. This is one of those unfortunate Stop & Shop departures. So they've been cutting back their store count pretty dramatically in the Northeast, and this is one of the obviously underperforming locations that was on the cull list.
Yeah, and this is just an example of what happens when you have effectively single tenant exposure, where they're occupying 80+% of a center. If they decide to leave, it spells real trouble for the center, especially for some of these that probably have some obsolescence built in and need to be, dramatically remodeled, if not cut up and subdivided to try to get released. So it'll be interesting to see, if and when this foreclosure is processed, if the new ownership group comes in and actually tries to convert this into something that's a little more modern with multiple tenants, smaller footprints, et cetera, or if they continue to market this as effectively an anchored type of center with a bellwether tenant.
Now that we've wrapped up the credit stories, let's move on to our digging through the data segment to close this out.
Yeah, so we haven't done a digging through the data segment in a while, but I'm glad we're bringing it back. We had our research team go through and aggregate some data. So Stephen, I'm going to run through these and you can add some color on this. But we looked at distress rates by property type, we looked at distress rates by vintage, and we looked at distress rates by debt source. And so effectively, we're looking at delinquency, watch list, and special servicing. And so if you look at the sectors right now, office is sitting at about 27% of the sector is on a watch list. About 11.63% is specially serviced, and just over 8% on the delinquency. Compare that to, say, multifamily, where you have 9% on the watch list, less than 1% in special servicing, and a very small single-digit delinquency number. Lodging kind of jumps off the page at some level, where watch list on the whole is about 31%. Special servicing is just over 6%, and delinquency is over 5%. So it's really interesting to kind of look at these. It's surprisingly how high some of these sectors are on the watch list across pretty much all of the categories. I don't know if that's a byproduct of upcoming maturities for some of these and they get added to a watch list, or if there's something underlying each of these individual segments that's driving the watch list narrative. What do you think about this data that jumps off the page at you?
So for me, the industrial sector jumped off the page massively. I'm kind of drawn to shiny things, and that has the largest bar for watch list, believe it or not. Just over 40%, so call it 41% of CMBS industrial loans are on the servicer watch list. And that's just crazy because you have under 5% of industrial loans are delinquent and under 0.4% are specially serviced. So the purest measures of distress are signaling all clear, but you have this watch list metric just sticking out there. But if memory serves me correct, you have some of these loans that are running at a very tight debt service coverage ratio. And as you mentioned, Lonnie, you do have some large upcoming maturities. Specifically, there's a very large industrial portfolio hanging out there that I believe is a SASB deal with still 1 or 2 extension options remaining on it. And I'm pretty sure that's what's driving a big chunk of that spike is just some, thin DSCR coverage industrial loans hanging out there, where the reality is you probably have a lot of upside potential on gain to market when those leases get renewed.
Yeah, I think I'm glad you picked out that bar chart. I have omitted it with the hopes that you would grab it, and you did. And to your point, there's a lot of industrial portfolio loan data in this underlying data set by really big players. I would say while that one is the highest on the list, that's the one I would pay the least attention to in terms of real concern, because to your point, there's still a lot of pent-up demand and leasing rate power in the favor of the owners for these buildings. So let's move on to our next topic here, distress rates by vintage. So we broke out issuance, vintage, we went back to 2014 to current. This is an interesting chart in the sense that 2014 jumps off the page with the highest percentage of watch listed deals. It's about 37%, but there's a pretty significant spike in 21. 21 has about 25% of the origination vintage being on the watch list. 2022 is at about 17%. So for loans that are fairly recently issued, you wouldn't typically expect to see any type of distress signals coming out from there. 2021, however, coming out of COVID, a lot of floating rate debt. We've talked about this ad nauseum. You're starting to see some real challenges with some of those loans, even in the short term. From a delinquency perspective and special servicing perspective, really nothing from 2024 back to, say, 2020. All of the distress on these are some legacy stuff that goes back to maybe 2014, 15, and 16. Nothing really on this that jumps off the page other than the spike in 21 and 22 from the watch list perspective.
I have some supplemental data points here on vintage performance just for fun, because we got asked this question within the last week or so from one of our friends at the New York Federal Reserve, who was wanting to know a little bit more detail around post-GFC performance of conduit deals. So just for some fun stats here, when we're talking about just the post-GFC conduit deals, the 3 deals with the highest loss percentages, and that's as a percent of the deal, the 3 highest loss deals in rank order 1, 2, 3 are a 2012 deal, a 2013 deal, and a 2014 deal. And the losses in those 3 deals, respectively, have peaked out at 14.8%, 13.5%, and just under 11%. So for some context for our listeners out there, what these losses mean is that's how high up the capital stack losses have eaten. So probably the simplest way to think about this is in a CMBS deal, the highest rated bonds, AAA. And that gets, down single A, triple B, et cetera, all the way down to the non-rated, the riskiest tranches. So if you're thinking about this on a ratings basis, losses have eaten up to the A-rated tranche on that 2012 deal with the highest loss. And that's the same is true for the second highest deal. The deal with the third highest loss, that 2014 vintage, losses ate up to the triple B minus tranche. So, this is well into the investment grade part of the stack, at least for those two deals that have the highest losses in 2012 and 2013.
And we talked about that and have a couple of slides that kind of go through and look at those loss by vintages. And if you didn't request a copy of that and you still like it, you can certainly send us an email at podcast@trepp.com and we'll send that over to you. And then lastly here, and we'll go to programming notes and shout outs, distress rates by debt source. So not surprisingly, Fannie, Freddie, pretty much zero, Ginnie, pretty much zero, CRE, CLO, pretty high relative, 38% on the watch list, set about 6% on the delinquency, and about 5.5% on the special service. CMBS is 28% on the watch list, 5% on the delinquency, and almost 8% on the specialty service. So, maybe one that's surprising is Freddie Mac currently has about 15% of their loans showing up on the watch list right now. So atypical for them given the nature of those deals.
Now, just a little bit more color on the CRE CLO sector. If we zoom into just the multifamily property type within CRE CLOs, and we look at the percentage of loans within a given MSA, specifically remember, these are multifamily CRE CLO loans with a debt service coverage less than 1. Get this, Lonnie, 100% of the multifamily CRE CLO loans in Detroit, 100% have a DSCR less than 1. Second up, Denver with 97.2%. Washington, D.C. has 96.3%. Houston at 88%. And coming in fifth, we have LA with 86.87% of multifamily CRE CLO loans in that MSA, but DSCR less than 1.
Yeah, those numbers generally apply to occupancy percentage. In this case, we're talking about loans with debt service coverage less than 1. It's not a great sign. That is a great segue, though, Stephen, to a research piece that we're going to be putting out where we look at top MSAs across the U.S. and we actually bifurcate out a list of the top 3 performers and some of the bearish bottom 3 performers. If you want to request a copy of that, again, just shoot us an email. We'll be more than happy to share that with you as well.
This week, we have 2 programming notes and 2 upcoming webinars. We talk about our Market Pulse webinar on the pod a lot. And Lonnie, thanks for bringing it up today. Our August webinar is 2 weeks away on Thursday, August 29th. We'll be covering 2024 office maturities, July MSA performance, and series sales data, so don't miss out. We're also excited to be hosting a CMBS market update webinar with our friend Shlomo Chop, where we'll be showcasing recent Trepp CMBS distress data and sharing insights into negotiating real estate loan workouts. Keep an eye out for registration information for both webinars via email and on our social media channels. If you'd like to be added to the email distribution lists to register for either webinar, please email us at podcast@trepp.com. Now turning to shout outs, Matthew G is a student at Bryant University and a fan of the TreppWire pod. He found us when he was interning on a real estate team this summer. Charles K is also a massive fan of the pod who replays portions for the benefit of his CRE lending team on their weekly calls. The TreppWire team plans on meeting Charles in person at the Western States MBA. So again, if there is anyone else listening who is attending the conference, reach out to us at podcast@trepp.com if you would like to connect. There were also a few shout outs this week on social media. On X, Real Estate Rookie mentioned TreppWire as one of the best CRE pods by far. Andrew V mentioned that the TreppWire pod tops the list for him, noting how mountains of quality macro data coupled with market insights, trends, and commentary are what you can expect from our show. And lastly, on LinkedIn, Carson B gave a shout out to the TreppWire podcast in a post of his favorite series shows, sharing that our weekly show discussing CRE and CLO markets on the national level is great content for a 50,000-foot view of the space. We appreciate all the shout outs, and I appreciate you, Lonnie and Stephen, and Haley, if you're listening in Italy, for allowing me to guest host this week and next. With that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the TreppWire podcast with your favorite provider. Thank you for listening and stay well.
All right.